How do you go about proving that a platform, not you, was required to collect and remit California sales tax? Well, many online sellers here in California and elsewhere assume that Amazon, Walmart, or another platform handled all of their California sales tax obligations. Sometimes that's true, sometimes it's not. And during a CDTFA audit, the real issue is not what the platform was supposed to do. It's about what you can prove. Hi, I'm David W. Klasing. I'm a dual licensed tax attorney and CPA, and I'm the owner of the tax law offices of David W. Klasing. At present, we have over a dozen California locations to serve you. Today, I'm going to explain how California Marketplace Facilitator's rules actually work, what records you're going to need to win an audit, and how to prove that the platform, not your business, was responsible for collecting and remitting California sales tax. Well, first of all, you need to understand what the Marketplace Facilitator rules actually do. Since October 1st, 2019, California generally treats a qualifying Marketplace Facilitator as the retailer for California sales tax purposes. That means that the platform, not the marketplace seller, is typically responsible for collecting and remitting the California sales tax on facilitated sales. But that does not eliminate sales tax audit risk here. So what do you have to prove in a California sales tax audit in this scenario? In a CDTFA sales tax audit, you got to prove that the sales were facilitated by the platform, that the platform was registered with California or required to be registered with California, and that the sales tax was actually collected and remitted. Without that proof, the CDTFA may assess the required sales tax against you. What are the best records to maintain here? Well, the strongest California sales tax audit file includes marketplace agreements, seller permit numbers, settlement reports, transaction level sales reports, tax collected fields, and payout statements, and especially records that separate marketplace sales from direct sales. The key is to tie every deduction to actual facilitated transactions. It's important to remember here that direct sales still create liability. Many sellers lose these type of audits because they assume all online sales were marketplace sales. Well, California does not make that assumption. Sales through your own website are direct sales, and direct sales keep you fully liable for California registration and sales tax reporting, even from outside California if you meet California's economic context nexus requirement. Also, their special rules around drop shipments and district tax issues can complicate this analysis. Listen, not every platform or app automatically qualifies as a marketplace facilitator. The individual contract, the platform's registration status, and the transaction structure itself must all align. Older audit periods may involve special relief provisions, but these provisions are narrow and highly fact-specific. Simply arguing that the platform was supposed to collect and remit sales tax is not enough to prevail here. California sales tax audits turn on documentation on what you can prove, not what assumptions you were following. So in closing, if the CDTFA is questioning whether a marketplace facilitator actually collected and remitted California sales tax, this is the stage to act very carefully. At the tax law offices of David W. Klasing, our dual licensed tax attorneys and CPAs help businesses nationwide separate marketplace sales from direct sales and build the documentation needed to defend this type of a CDTFA audit. Call 1-800-681-1295 or visit klasing-associates.com to schedule a confidential, reduced rate initial consultation today. You won't regret it.